think, act, and prosper. You are now tuned into the Money Level Show.
Doom, glad to have you back on the show.
Daryl, great to be here. Good to see you again, my friend.
Yes. I'm super excited to have you back. Love just listening to you, hearing your takes on multiple different concepts. And I've heard you talk a lot about oil recently. I watched the peak oil debate a while ago, and so oil's been obviously staying elevated. But today, I want to talk about inflation. Let's start with inflation because I've been researching for a while, and I suspected that inflation would start to tick back up, and it seems like the Fed is worried. Jerome Powell just came out and said that they may need to keep the rates higher for longer because inflation is going the opposite direction of where it was going late last year. And so I wanted to get your take on inflation and do you see this being a sustained period of high inflation, or just get your take and just a general on it?
Yeah, I think obviously we listened to Powell or read Powell's remarks with some interest. I think one of the drivers of inflation is that the U.S. economy is coming in a little hotter than perhaps some had anticipated. But also I think there's a global rearranging of supply chains, due in large part to the geopolitical risks associated with issues in the Middle East, and of course, the war in Ukraine as well, and tensions with China. And so we're seeing a wave of onshoring, reshoring, friendshoring, and there's clearly elevated risks geopolitically, which I think is driving increased logistics costs and so on, and a relatively tight labor market. I mean, as much as people criticize, official government numbers in this regard, sometimes I think that we're just seeing stronger than expected numbers, and the market has been reading Jerome Powell so wrong for so long. It's really amazing. I mean, he's not going to raise that high. He's going to cut much sooner. We're perpetually underestimating the lengths to which Jerome Powell is willing to go. And then the last thing I would say is the U.S. is running massive fiscal deficits. This is an inflationary pulse. Even the elevated interest rates find their way back into the economy as a sort of a fiscal stimulus for wealthy investors. The velocity of that money may be less than direct handouts, but it's nonetheless money going back in, circulating into the economy. And so we're not near the inflation levels that we were at the apex of the post-COVID crisis, but we are still uncomfortably high for the Fed, if you take Jerome Powell at his words. And I think there's this belief in the market that Powell will ultimately cave to political pressure and cut ahead of the election and so on. But we shall see. It's an interesting time for sure.
Yeah. It seems like, there's these different levers of inflation. I mean, this is my first time experiencing inflation, but just from reading, work like yours, Lynn Alden, and many others, just learning about how you have fiscal-driven inflation, you have Fed-driven inflation, and then and there's different components. I mean, the 70s had I think it was a lot of more bank credit creation during that time or something of that nature. But it seems that now we're at this point where we came out of the pandemic. The Fed was quantitative easing significantly. They were pumping a lot of money into the economy, into financing the government's deficits, and then now we still have the government spending recklessly. So is that your assessment, that the government's spending, the deficits and everything, that's what's driving inflation?
I think it's a combination of three factors. I think oil prices are still very elevated, even though the rest of the primary energy complex is relatively balanced at the moment. But at $85 a barrel oil, that's still relatively expensive, and that finds its way into the economy. I do think a primary driver is fiscal spending, like I said before. Then also these increased friction costs in the operation of the global economy. I mean, I think that shipping out of the Red Sea has been significantly disrupted. We're seeing this move out of China by many of the Western countries. And so I just think, economies are chaotic and difficult to model. And the Fed has been signaling the favored parameters that it intends to measure and make decisions by, and those numbers have been coming in hotter than the Fed would like. And so um, we'll see if Powell is true to his word. The position of chair of the Federal Reserve has become ever more political, and we're heading into a very hyper-political environment with the upcoming elections. And so time will tell. But the numbers, I feel them in my real life. It doesn't feel like prices are moderating to any significant extent, at least for the things that I spend my money on, food and gas and groceries. And I'm old enough to remember when you could get a Big Mac meal at McDonald's for $3.99, and when you drive through now, it's far higher than that. And so, and to many people as well, that people feel elevated prices. If they don't come down, they think inflation isn't abating. But in reality, inflation could just sort of stay flat here, and people are still hurting because prices are so much higher than their wages have been going up. And if it just stays here, I mean, what you could get for $100 at the grocery store today is it's compared to pre-COVID. I mean, it's pretty incredible, right? And so, and I think the price of gold is signaling that, and so we're in quite the dilemma, and it's going to be a fascinating few months to see what Powell does ahead of the elections for sure.
Yes, it's interesting because you say that because I have been looking on my social media and friends and people I know in my community. Like one of the biggest complaints that I've seen is the rise in car insurance prices, and so I've seen that quite a bit, and I haven't looked into it much. And I recently read an article about it, but I know that my car insurance has to renew in June, so I'm just like expecting higher prices.
Well, beyond that, since I left the corporate world and you have to buy your own insurance, and I've been in the so-called Obamacare exchanges as an entrepreneur, and every year the price of my monthly premium goes up 8%, and the copay goes up, and the total quality of insurance that you can buy goes down. And I can see the numbers. Like, this is what I paid in 2018, and this is what I'm paying in 2024, and compounded over that time, I think it's up 6% for me per year, compounded, not total. It's just incredible, and I see it. And by the way, come January, I know I'm going to get another bill. Your premiums are up 7%. Like, and so it's the things that people have to live with. Like, they can't live without car insurance. Just like you're legally mandated to have your car insured before you're allowed to drive on the road. Home insurance is skyrocketing. Health insurance is skyrocketing. Medical costs are skyrocketing. You can't get a handshake at the hospital for less than $1,000, right? And so and food. I think food is where it really hits, and that's where I think I noted with interest that instead of refilling the Strategic Petroleum Reserve, there was talk and rumors and jawboning this week that Powell would release more of it in order to manage oil prices ahead of the election. I think that $85 oil is starting to spook the president a little bit as we come into the final stages of the campaign.
Yeah. I think the prices are up close to $1, at least where we live in the last few months, and so I've definitely been seeing that. You mentioned gold earlier, and that was one thing that I wanted to really chime in on. So obviously we have inflation. Gold is at all-time highs as it is measured in dollars, and right now there's so many factors I think just in favor of gold. I mean, we got geopolitical tensions, sticky inflation, and gold is still doing well in this higher interest rate environment. And then you have the massive deficits in central banks buying the gold. So it just seems like gold has a lot of things going in its favor. And normally which was pretty interesting. Usually when the interest rates are higher, gold is a little weaker, but it's reaching all-time highs in the environment of higher interest rates. So what are you seeing there on the gold front in terms of, like, do you think that this is a sustained bull market in gold? You think the price is going higher? What is gold responding to? What's your overall sentiment about it? Time out. Quick break in the action. This message is brought to you by the Rule Symposium. This annual symposium is hosted by the legendary investor Rick Rule himself. It will take place from July 7th through 11th in Boca Raton, Florida. Mr. Rule invites some of the most brilliant minds in macroeconomics and natural resource investing. This year, featured speakers include Danielle DiMartino Booth, Nomi Prinz, Jim Rickards, Grant Williams, Lobo Tigre, and more. Rick even organizes the Living Legends panel where he invites individuals who have built billion-dollar businesses from scratch. Attendees will be introduced to a myriad of companies active in the natural resources space, with the companies invited being the ones that Rick Rule invests in himself. The symposium is held at the Boca Raton, which is an amazing resort with exceptional amenities. I attended in 2023 and thoroughly enjoyed my time there. I went on an amazing cruise with Rick and other investors and CEOs of companies, and even had the opportunity to test drive an Aston Martin for the first time. So don't miss out on this opportunity to have fun and receive high quality education to help secure your financial future. Click the link below to sign up, and I promise you won't regret it. But if you do, Rick offers an amazing money back guarantee. So what are you waiting for? Click the link below to sign up today. Now, without further ado, let's get back to the content.
Yeah, at the beginning of January, we wrote a piece called Golden Resolution. And the social preview for that piece was, one way or another, 2024 is setting up to be a historic year for gold. And in that piece, we made two core arguments. One, that the seizing of the Russian reserves set a very bad precedent for Western debt instruments to be continued to be used as neutral reserve assets in the settlement of international trade, and that wind was in the sails of gold to take more of that market share, so to speak, which is, I think, consistent with what you said, which is we're seeing central banks load up on gold, perhaps ahead of the next Bretton Woods conference, to pull a name from history. But the other thing that we said in that piece, which we admittedly borrowed from Luke Groman, who's brilliant over at Forest for the Trees, is that the opening of this physical exchange window in Shanghai looks set to call the bluff on whether or not paper prices of gold in the West have been manipulated downward by bankers. And this is a long-standing lament of the gold bugs, who believe that, unallocated gold and paper gold and futures manipulation were used to drive the price of gold down, because central bankers are worried that an explosion in the price of gold would feed inflation expectations in a sort of self-fulfilling spiral of inflation pressure. And the fact that you can short gold in London and stand for delivery for it, and then get long gold in Shanghai and so on. The net effect is that you get long gold in London, and then you stand for delivery, and you short gold in Shanghai, and you close that short with physical because there's a premium that's opened up. In other words, the price of gold is more expensive in Shanghai than it is in London. And that's a new artifact of the markets that have developed, especially the physical delivery markets in Shanghai. And so if gold is trading for $50 an ounce higher in Shanghai, there's an arbitrage, and the net effect of that arbitrage is gold is flowing out of Western vaults and going to China. And we see this in the gold import numbers. And so one of the charts I watch every day is the Shanghai premium. You could pull it right up on your Bloomberg, and today it stands at $35 an ounce. That's actually a pretty substantial premium. It's gotten as high as $80 to $100 an ounce. And so if you have free money available, arbitrageurs are going to go in and grab it. And so effectively, the Shanghai physical delivery window could put an end to the paper manipulation of gold, because you don't necessarily want all your gold to end up in China, especially if it's going to be a more important neutral reserve asset in the settlement of international trade. And so every day we come in and we see where gold is trading in Shanghai, and we compare it to where gold is trading in London and New York. And as long as there is a premium that tells us that there's bullish tailwinds to the price of gold, and there still is a premium. And that's why I think we see gold marching higher nearly every day, regardless of interest rates. I don't think, when you see a chart like that, the real rates versus gold open up an alligator jaws like this, and those jaws don't close, that tells you that something has fundamentally changed in the markets. And we think what has fundamentally changed is this ability to buy gold in London and sell it in Shanghai for a profit, risk free, and people are doing it.
Hmm. Yeah, yeah, definitely. And do you think that any of the geopolitical tensions, in terms of we have Middle East tensions, obviously when Russia first invaded Ukraine, the price of gold spiked significantly higher, and it hasn't come back down a whole lot since since uh, since that occurred. So, do you think that some of that is playing into this as well, where people may go to a safe haven asset whenever there's a lot of uncertainty in the world, and then obviously the fiscal deficit and debt situation?
Yeah, we saw that last Friday as gold kind of traded like Nvidia for an afternoon. Gold shot up to a record high and then dropped by something like $100 an ounce, all on the news of a potential retaliatory strike by Iran on Israel for Israel's alleged destruction of a consulate, an Iranian consulate in Syria, and concerns about World War III. I would note with interest that Bitcoin did not act like a flight to a safe haven asset during that time. It traded in the opposite direction to gold. Just an interesting observation. But gold spiked on the news of war and then um, fell on the news that perhaps this might be a little bit more choreographed and theatrical than perhaps the headlines were letting on. But I see it's back up today, and so yeah, I do think it's a combination of all of those factors, Daryl. I think you have inflationary expectations, you have geopolitical risk, you have the seizing of the Russian reserves, which only amplifies risks and make gold more attractive. Because if you have physical gold in your country, it's not like the Western world can come and seize it, at least without an army. And then you have this physical exchange window in Shanghai that's driving arbitrage into the market. And as long as prices of gold are going up in Shanghai, they have to go up in London and New York eventually. And if we're in a new regime where the paper price of gold cannot be used to manipulate the physical price of gold, then all bets are off for how high it could go. Now, that's not investment advice. I own a ton of gold, mostly as a hedge against inflation. I'm not thrilled when gold goes up. It's the one asset that I own that usually signifies something else is wrong in my portfolio or in the world. And I'm more than happy to live in a world where we don't have inflation, gold is relatively steady, and the world is at peace. We don't have any of those things today. And so on balance, it's not pleasing for me to see gold at $2,400 an ounce as it's trading today.
Yeah, yeah, because that definitely means there's some turmoil in other places, and gold is that insurance. So, in terms of like you mentioned the paper markets, we've seen like the physical the stocks, the gold stocks, they haven't really been doing very well, and obviously, I mean that has different factors. I mean you got mining costs and inflation and such, and you would think that with gold being at $2,400 an ounce, that these mining shares would be performing a lot better. Do you have any insight on that?
Yeah, we've largely stayed clear of trying to express a bullish view on gold by taking positions in gold companies. But there's just one fundamental problem with the whole sector, which is management teams routinely disappoint investors, and it becomes difficult um, to know who to trust in the market. So like there's lots of people who make lots of money trading penny stocks and junior miners and all that stuff, but they spend way more time studying management teams and markets than we do. And so to them, congratulations, they've created alpha for themselves. But for us, it's far simpler for us to just own physical gold or buy the Fizz ETF and call it good. And we do, when we invest in companies, we do it privately mostly anyway. And so this just doesn't fit with our investment profile. But generally speaking, at the highest level, junior gold miners are filled with let's just a wide a wide variety of management quality, and most large investors sort of stay clear of the sector for that reason, and that's why you see many frustrated retail investors. They own these gold stocks forever. Gold's gone up 25%, and their stocks haven't moved. Most people would, I think, just rather own gold.
Yeah, yeah. In my recent conversation with Jim Rogers, he said he doesn't touch the gold equities. He's just a physical. So
Mm-hmm.
that was
Mm-hmm.
that was, I mean, just from a legendary investor such as himself, like that spoke volumes.
Indeed.
So silver. So silver's at 28, I think close to $29 an ounce. Do you have any view on silver? Obviously, it's more volatile, has industrial use, more industrial usage. Do you have any take on silver?
Yeah, silver's a little more convoluted than gold because it does have this large industrial application, and it's not considered a monetary metal at the same level that gold is, although there's still some sort of moneyness to it, if only from a historical residual perspective. I think the price of silver, beyond just sort of speculation, is heavily dependent on the ebbs and flows of the solar market because of its use in that application. And if you think we're at peak ESG, then perhaps demand for silver might not materialize the way it's projected. If you think solar is going to continue to boom for decades to come as the world struggles to get the climate change challenge under control, then you'd want to be bullish silver. But silver is a bit more complex than gold, and frankly, other than following the solar market, we don't really follow the ebbs and flows of supply and demand in silver all that closely because we don't have material position in it, and it's just not something that we normally write about.
Mm-hmm. Okay, yeah, that makes sense. And then, are you following any of the platinum group metals at all in terms of what's happening there?
No, same story. I mean, platinum group metals driven by, the need to clean automobiles predominantly. But again, it's just not a market that we spend a lot of time on. In the past 18 months, I'd say we spent 80% of our time on energy, just given the plethora of things to write about there. And so, yeah, nothing unique to add. I'm aware of the space. I have a few friends who are big investors in the space, but nothing that I can add that your prior guests haven't already articulated, I'm sure.
Mm-hmm. Gotcha. And then uranium. So we've talked multiple times on uranium. We had a huge price spike in uranium, hit over $100 a pound. We've had it cool off since then. Yeah, you have any updates there on the uranium market?
Yeah, when it was reaching all-time highs, we were a bit cautious on a few podcast appearances, saying, like things don't go up forever, and just kind of had a feel of an Icarus print to it, and that perhaps a little bit of hedging or risk management might be called for. Again, not that we ever give investment advice. I think it's still a very healthy move. I was looking at prices last week. I think it's probably healthy for the market to consolidate a little bit. I do think there are significant tailwinds to energy, to nuclear energy, which necessarily means that there should be a strong bid under uranium. And then, of course, there's always, as the market develops and so on, that spot price is just one indicator of uranium price firmness. It's the one that most retail investors get to express a view on through the Sprott Physical Uranium Trust, for example, or their related equity uranium ETF. But in like most industries, spot is just sort of a guidepost for negotiations between companies who write long-term contracts and so on. But those are coming up rather healthily as well, which bodes well. But I do think we have significant tailwinds overall. We're still very bullish nuclear power. And so that's sort of our overall view on the market. When something goes from 50 to 110, in the blink of an eye, it's probably not going to go to 300 in the next blink. And so, you could just tell by going on Twitter that it was feeling a little toppy. There was a lot of spiking of the football and so on. And I'm very happy for those folks. I mean, I'm been an early believer in uranium. We've been writing about it from the early days of Doomberg. And I think we first wrote about it. We wrote about Cuppy's call. I think uranium was at $40 a pound. And so, it's been a good trade for many people, and we'll see how much juice is left in the squeeze. But it's been an interesting run.
Yeah. I've been seeing like a lot more articles on it. Obviously, government adoption and laws being passed, and then also mines reopening and production coming back online or whatnot. And so it's been pretty interesting for me. So there's talk about this Russian enriched uranium ban, and I'm just kind of wondering what implications could be there if that were to take place.
Yeah, I don't think that's something we're going to rush to do. We're pretty dependent on the uranium enrichment in Russia for keeping the lights on in the Western world. Um, just yet another reason why the sort of geopolitical situation in the world would be great if we could sort of resolve some of these crises and get back to a bit more normality. This is a challenge, but not one which can't be solved with a relatively manageable investment. I mean, I think the Western world could satisfy its enrichment needs with an investment level of like less than 10 billion. The technology is very well known. And given the amount of money we're wasting, the fire hose of money that we're wasting on solar and wind, you would think that the US DOE, who has, wholeheartedly got behind the nuclear renaissance, would be able to scrape up $10 billion and solve the problem. So it might cause some short-term issues, but the bigger issues they cause, the quicker they will be resolved. As is always the way with commodities. And here, it does not require much in the way of technical innovation, nor does it require much in the way of funding. I mean, look, $10 billion is a lot of money to you and me. But the average appropriator in Congress might not bend over to pick up that amount of money if they saw it on the sidewalk. I mean, we waste so much money in Washington, D.C. that I find it hard to believe that such a high percentage of our national electricity generation would be left to the whims of Vladimir Putin for too long, should he, for example, decide to preemptively impose an export ban to get ahead of any sanctions on the material. So it's not something that keeps me up at night, and it certainly wouldn't be the foundation of a bullish thesis investment for uranium for us.
Mm-hmm. Yeah, and you mentioned earlier just in terms of you don't see that happening very quickly, and it's pretty interesting because like when Russia first invaded Ukraine, the United States response to take them off SWIFT system, it just happened like in a snap of a finger. But in this particular case, like they've been talking about the Russian uranium ban for a number of months, and they're very very slow to do it.
Well, yeah, because again, like you don't want to cut your nose off to spite your face, right? I mean, that's kind of the thing about this entire sanctions policy, which, as we've been very critical of from day one, and I think history has shown that our objections to the strategy were largely correct. Um, you know, exercising leverage. In order to exercise leverage on a geopolitical opponent, you actually have to have the leverage, right? And so, if we need something, we better hope that Putin doesn't just unilaterally cut us off. And so, like, we've been studying the sort of war situation carefully, and we're going to do a presentation this month to our pro tier on it. Like, we have this ability to continuously underestimate our geopolitical foes and overestimate our own strengths. And look, I mean, in the end, power is decided on the playing field. Like you can say, wow, those running backs are very weak. And then when they run over your linebackers, well, you don't keep saying that those running backs are weak. Like it's just like, and we're seeing like Russia's winning the war in Ukraine, and they're out producing NATO. They're not a gas station, a country with a gas station on it. I mean, they have very sophisticated industrial processes. They have very sophisticated weapons. They've drawn red lines in the sand. We've chosen to support Ukraine in the war, which are fine. Like these are all decisions that, who are we to second guess? But at the same time, to just assume that, that the whole thing is a house of cards, and like China is the arsenal of democracy right now because we've outsourced all the democracies have outsourced all of their manufacturing to China, especially in military supply chains. So, and then we think we're just going to go to war with China, and then they're going to keep producing for us. Like, some of this just boggles the mind. Like, I don't know what people at the top are thinking. Like, if we desperately need Putin for the enriched uranium that we need to keep our existing fleets of nuclear reactors going in the West, then of course we're not going to sanction that uranium. And perhaps we should have pondered that before we, decided that a diplomatic solution was unacceptable before the war started. And I see in foreign affairs now it's suddenly okay to say that there was almost an agreement between Ukraine and Russia and that the West scuttled it. If you had said that 18 months ago, you would have been labeled a Putin puppet. And so, we're coming to grips with the fact that we made some moves where we underestimate our enemies and perhaps overestimated ourselves. And I think a little humility in Western diplomacy would probably go a long way.
Mm-hmm. Yeah, agreed. All right, so I just want to, as we wrap up, I just want to get your take on if you have a take on it. There was a lot of the soft hard landing debate. We still haven't seen recession yet. We still haven't seen a hard landing. We did have some discrepant some discrepancies in the data. Some economic indicators would say we're looking at recession. Others were saying like the jobs were saying that we're actually in a strong market. I mean, you had consumer spending numbers and all of these different opposing forces or whatnot that were saying one saying that we aren't going to have recession, and then one saying that we are going to have recession. And we're obviously in an election year. And you mentioned earlier about if Powell is going to cave to political pressure or whatnot. And so I'm kind of wondering, do you have any take on the U.S. economy in terms of soft hard landing or whatnot?
Yeah, so we put out a piece called "Slick Landing," where we made the call that the U.S. would not see a recession in 2024, predominantly because the country is swimming in an ocean of cheap hydrocarbons. Look, I just pulled up on my Bloomberg natural gas in the Permian Basin at the Waha Hub. Spot price is minus $2.40 a million BTUs. They're paying people $2.40 a million BTUs to get rid of the natural gas nuisance that they're co-producing with their oil. Natural gas is valuable. We wrote a piece on just how valuable natural gas is for the U.S. manufacturing sector. The front month price of natural gas at Henry Hub, which is sort of the national benchmark, is $1.70 per million BTU. That's the price of oil equivalent of about $10 a barrel. And natural gas is used for all manner of cogeneration of heat and electricity at heavy manufacturing plants. It's used to heat homes. It's used in the chemical industry to a wide extent. And so there's an enormous tailwind of cheap hydrocarbons flooding the US markets. And when you combine that with fiscal recklessness, this is not a set of ingredients that would feed a short-term recipe that would spit out an inflation once you put it in the oven. And so if you have a government willing to spend its way to the election, and you have the world's most abundant supply of cheap hydrocarbons that has ever been seen, you're not going to get a recession. And some people reacted negatively to that call, perhaps because they were hoping there would be a recession so that maybe Biden would lose the election or whatever. But we've got to call it as we see it. I mean, when you have look, the U.S. produces 30% of the world's natural gas, and it's basically free. Free, Daryl. Like you could, if you're running a fertilizer plant in the U.S., like give me some, right? Just fill me up. Like, and by the way, as we've written several times, like this bodes well for changing some of our engines. Like you could burn natural gas in a car, you can burn it in a long haul truck, you could burn it in a tractor, you could burn it in a dump truck. And if you're going to pay $4 a gallon for diesel, or somebody's going to give you natural gas for free and you could do the same work with it, we're going to change the engines. And we're beginning to see that. And so this was a call we made early on. I think it's stood up reasonably well. Look, not all our calls do well. Sometimes we make mistakes. We're not, we're not perfect like everybody else. But I think this was one that we feel, just based on our heavy industry experience, natural gas at $10 a million BTU would be the stuff of a recession, not $2 a million BTU. So we do think this is an underappreciated phenomenon. And most macroeconomists just treat energy like it's any other commodity. And I think that's a mistake. So that's our view on the matter. We don't anticipate a recession coming. We've had that view for the better part of 5 or 6 months. And I think that as the data comes in, that will be proven correct.
Mm-hmm. Okay. And then I'm just kind of wondering, so we have the talk about recession. So then we have like the government actually draining the reverse repo market. And that's been being drawn down quite a bit. And then there's a lot of concern about who's going to buy the government debt and such. And so how's the government, still going to be stimulating the economy and running these deficits? Do you have any view there?
I think none of that materializes before the election. And the election is sort of a singularity past which, the laws of physics break down and nobody can tell what's going to happen, because I think we're headed for a very dangerous election where half the country's not going to believe the result. And who knows what chaos follows after that. But I think all of those concerns can be easily punted to November. You can roll some CRE loans and help the banks avoid a crisis. I mean, we've seen this, right? The current administration is going to do whatever it takes to avoid a crisis between now and November, and I just think it would be foolish to bet on one. It might happen. We could be wrong. We'll try to figure out why we were wrong, and we'll write about it. But I just think reading the tea leaves, none of these problems. There's all manner of tools and tricks that Janet Yellen can use, not just Jerome Powell, to get everybody over the line. And the number one objective of Washington, D.C. is keep Orange Man bad out of the White House. And that's like a really good mental model that you could use to judge behaviors, and it works. And so that's where we are.
Yeah, definitely. Well, thanks, Doom, for giving us those updates and takes on many different topics, especially gold, recession, inflation. And so where can people find more about your work?
Sure. Yeah, we've since changed our domain name, so we're at newsletter.doomberg.com. We managed to acquire the Doomberg.com domain. We're still close, tied with Substack, and if you just put Doomberg Substack in, you'll get to the right place. But you can find all of our work and podcast appearances and our pro tier talks at Doomberg.com or newsletter.doomberg.com. Thanks, Daryl. It was really fun, and looking forward to the next time.
All right. Thank you.